Hey, VA borrowers. My name is Steve Doherty. I'm the Raleigh VA loan guy. I'm a loan officer here in Raleigh, North Carolina, and I'm a United States Marine Corps veteran. Today, I want to talk to you about refinance timing. When is the best time to refinance? Should that be now? Should you wait for rates to drop further? There's a lot to think about, but I have a simple rule that I apply to my own mortgage and to my refinance clients that help make that decision easier. Today, we're going to talk about what is the sort of break-even point on a refinance and how should that sort of influence your decision as to when to refinance. We're also going to look at some numbers, some interest projections over a few different categories, and we'll take a look at that and see how that plays in. So we'll actually look at the raw data. Let's take a look. Okay, so first of all, timing a refinance perfectly is impossible. No one has a crystal ball and no one knows exactly when rates will hit their bottom, right? For instance, a lot of people refinanced multiple times during COVID. Some people did 2 or 3 refinances as rates kept dropping. There's no way to know for certain when rates will drop, right? So this video is being made in March 2025. For really the majority of 2023 and 2024, your big brain experts who were forecasting mortgage interest rates, folks that I follow and who I respect, who I think are very, very smart, nearly all of them got it wrong in terms of a long-term forecast for a big rate drop, right? So they were calling for sub 5.5% on VA loans, 5.5% on conventional loans. They did that over and over again, and that big rate drop never happened. It never took place. So, and then toward the end of 2024, everyone was convinced as the Fed cut interest rates, mortgage interest rates would follow suit. Either way, just because mortgage interest rates tend to fall when the Fed cuts rates doesn't mean they always will. That happened over and over again during 2024. And I keep looking down at my calendar to check that I'm getting the dates right. It takes me 6 months to remember that we're in a new year. So I'm just checking to make sure 2024 is still accurate. But September, October, November, December 2024, the Fed kept cutting rates and mortgage interest rates didn't budge. In fact, they went up on a couple of those occasions, particularly in September. So be wary of banking, no pun intended, on a big rate drop at some point in the future. So how do you know when to refinance? What I did on my mortgage, and I refinanced my mortgage 3 times between 2018 and 2022, is that as soon as it made sense to refinance, I did it, right? That's kind of a way it's a risk-averse way to refinance. Some people may look at that the other way and say, well, if you keep refinancing, you keep incurring closing costs, or you keep increasing your mortgage loan amount, then that's actually pretty risky, right? But you don't know when you're going to get another chance to refinance. And that is the big point. When you refinance now, you don't know for certain if that is the lowest interest rates we'll get for the foreseeable future. If, let's say, rates drop down to 5.5% and they're only there for a week, and then they don't get back down to 5.5% for 2.5 years, and at that point they go below 5.5%, you may think, well, great, I waited for the market to bottom out. But if that 5.5%, if the cost associated with refinancing, those costs pay for themselves with reduced interest expenditure over the course of 12 months, then it made sense. You've made up the investment, right? Now, what happens if rates don't fall? Let's say they go down to 5.5%, right? Then you have a refinance that makes sense. Rather than refinancing, you kick the can down the road and you say, I'm convinced rates are going to fall. If they don't, now you are stuck paying interest at a higher interest rate on your current mortgage. And that is really the crux of the analysis. That's really why I think once it makes sense to refinance, you do it. If you refinance and it makes sense, meaning you're going to save $3,000 or more on your mortgage in the first 12 mortgage payments of that new refinance mortgage, it makes sense. And those are guaranteed savings. What do I mean by that? When you reduce your interest rate on a new mortgage, even if you're increasing the mortgage balance, you have a guaranteed amount of savings, right? You just compare what your projected interest payments would be on your current mortgage versus what the projected interest payments would be on your new mortgage, even if the mortgage balance is bigger. If you're guaranteed savings, then that will always work. You will save that money, right? Whereas when you wait to refinance in hopes that rates drop further, what you're doing is you're gambling on the hopes that you will save more money, right? You're waiting to save more money than you theoretically would now on a refinance. The problem with that strategy is you don't know for certain that rates are going to get lower. You don't even know for certain if rates are going to stay where they are. So what you're doing is you're comparing guaranteed savings right now versus the hope that you will save more than that in the future, right? And that is risky. Now, if you time it perfectly, that could work out pretty well. But remember, if you don't refinance, you're staying at that higher interest rate. So you want to move off of that as soon as it makes sense. So I like to use 12 months as sort of this litmus test of whether a refinance is worth it for a couple reasons. Number one, 12 months means that is a very high performing refinance. If you're recouping your investment within 12 months and the investment really is the closing costs of the mortgage, right? The costs you would incur by virtue of refinancing. In other words, if you didn't refinance, you wouldn't pay those closing costs. If you recoup that investment in 12 months, if you're already breaking even, that's a good refinance. And what this guards against is, let's say I tell you should refinance now. And then in 12 months, interest rates do drop, right? Well, I've already made back your money on that refinance. I've recouped that investment, so you really haven't wasted any money. Now, if rates do drop significantly, some people say, well, I could have saved more money if I had just waited. That's true. But again, you don't know for certain when rates are going to drop, by how much they're going to drop. But right now, if you can lock an interest rate that saves you enough interest to recoup your closing costs in 12 months, that's a fact. That's not projection. That's not conjecture. And that's why the safer bet is to lock when it makes sense. Now, let's take a quick look at some numbers, some comparisons between some hypothetical mortgages and see how those numbers play out in the real world. Let's take a look. Okay, so here we have the example of motivated mortgage man who purchased a home in Raleigh, North Carolina during the summer of 2024. He paid $500,000 for it and did 100% financing on a VA loan. His interest rate was 6.25% on a 30-year mortgage. We're going to compare that against a refinance that is available now at 5.5%. It's also a 30-year fixed rate mortgage. So that 5.5% is available now. The interest rate or the loan amount is increasing by a little bit because I'm contemplating that he would be financing closing costs, prepaids, and escrows, right? The next scenario is a 5.125% available in 6 months. So, and this is going to have a slightly smaller starting loan balance. This is probably a little bit generous. It'd probably be a little bit more than that. But the borrower would be paying some of that principal down over those additional 6 months. So again, we have a 5.5% interest rate that's available now versus a theoretical 5.125% that maybe would be available in 6 months. In other words, this borrower expects or is holding out for rates to drop another 3/8 in 6 months down to 5.125%. So let's see how that works out. Let's see how his projected interest is different, right? So let's look at the 1 year mark, right? At 1 year, by refinancing now to the 5.5%, the borrower saves $3,253 in interest, okay? Ignore this number for now because remember, this mortgage doesn't start for 6 more months. So at the end of 12 months, the borrower has saved $3,253 by refinancing now to the 5.5%. Now let's take a look at what the borrower would spend in interest by waiting 6 months, but getting a 3/8 lower interest rate at 5.125. So this is $15,450 plus $12,826. The first 6 months added up to 12 months. That gives a total interest expenditure of $28,276. Okay. So, and then we're going to flip back to the 1 year interest expenditure. So you can see that the borrower is going to spend more money over the next 12 months by waiting for the 5.25, right here, 28,276, versus refinance at the 5.5 now, which is a total interest expenditure of 27,551. Now you may be saying, well, that's great, but that's only at the 6-month mark, right? Surely over time, the 5.125% is going to outperform the 5.5. Well, let's take a look at that. Okay, so at the 1.5 year mark, at the 18-month mark, the 5.5% now will cost $41,183 in interest. Now we're going to add the 6 months at the 6.25%, right? That 15,450. And then we're going to add it to 12 months at the 5.125%, right? That 25,559 for a total interest expenditure of $18,009. So now let's compare the 18 months of interest on the refi now, the 41,183, versus 6 months at the 6.25 and 1 year on the 5.125. So the total over 18 months on the waiting to get the 5.125 is $41,009 in interest, right? So that is less by $174 than the total interest spent at the 18-month mark. So, okay, the 5.125 at about the 18-month mark is starting to outperform the 5.5 now, right? Let's look at one more scenario. Let's look at 36 months. Okay, and on the 5.5% now, this borrower will spend $81,481 on interest. If we take the first 6 months at the current interest rate, right? Again, that's that 15,450. And we add that to the interest spent over 30 months on the 5.125, we get a total interest expenditure of $78,269. Okay, so at the end of 3 years, the 5.125 has saved $2,852 more than the 5.5, right? And it's really starting to outperform this other mortgage. Here's what you need to keep in mind about this strategy. Number one, the motivated mortgage man does not know for certain that in 6 months rates will drop to 5.125. There's no way to guarantee that. If he refinances now at the 5.5, all these interest expenditures and the interest savings are guaranteed as soon as that interest rate is locked. Waiting 6 months for an additional interest rate is not guaranteed, right? Rates, maybe they stay the same. And you think, well, if they stay the same, maybe that's, he's not losing anything. Yes, he is. He's losing something because he'll stay 6 more months at that higher 6.25% interest rate. Now, here's the real good way to look at this whole scenario. By holding out for the 5.125, let's say he times it perfectly in 6 months, interest rates drop down another 3/8 to 5.125%. That means he is gambling on significant mortgage interest savings in order to capture an additional $2,852. Okay, now let's show where I'm getting that math. Refinancing now at 5.5 guarantees the borrower $9,720 in interest savings over the course of 36 months. So what Motivated Mortgage Man is doing is he is gambling $9,720 in interest savings for the opportunity to save an additional $2,852. And that is the main crux of the analysis, and that's why waiting to refi is risky. Yes, if he times it perfectly, he will save more money, but it's not guaranteed savings because we don't know what interest rates will do in the future. And you're comparing that to at current market conditions, once the interest rate is locked, guaranteed savings of $9,720. Okay, so we see now how those numbers stack up, and you can get a better understanding of why it can be important to kind of get while the getting's good, right? When that refinance makes sense, you move on it and you don't wait. Now, you could be thinking to yourself, well, this guy makes a living doing mortgages and doing refinances. Of course he wants me to refinance soon, right? And that is true to a degree, right? That's how I make a living. But you can't deny those numbers, right? You can't deny that if you refinance once it makes sense, that you're going to have guaranteed savings, right? And then the comparison for you is, do I want to have guaranteed savings, or do I want to risk having no savings in order to attempt to achieve more savings? That's why at the end of the day, I think it makes more sense to refinance soon rather than later. Thank you so much for watching this video. If you would like me to give you some feedback on whether your refinance makes sense, when you should do it, or better yet, what your target refinance interest rate should be, please reach out. Send me an email, shoot me a text message, give me a phone call, leave a comment below. Either way, I'd be more than happy to talk to you, walk you through your options, and explain your best decision. Again, I'm Steve Doherty. I'm the Raleigh VA loan guy, a loan officer here in Raleigh, North Carolina, a United States Marine Corps veteran. Thank you for tuning in. Please subscribe to my channel to watch more videos, and I'll be in touch.